Market crashes don't destroy wealth, they transfer it. From the unprepared to the prepared. From the emotional to the strategic. From those who panic to those who position. And if you understand the patterns, the next major crash isn't a disaster to fear, but an opportunity to exploit. History shows us that every 18 to 20 years, the financial system reaches a breaking point driven by excessive debt, rampant speculation, and artificial prosperity maintained through monetary policy that creates bubbles rather than sustainable growth. We had the dot-com crash in 2000, the housing crisis in 2008, and if the pattern holds and every indicator suggests it will, we're looking at the next major collapse around 2026. This isn't doom prophecy. It's pattern recognition based on how the debt system inevitably breaks under its own weight. The Sabio Observer recognizes that crashes are features of the system, not bugs. When central banks keep interest rates artificially low for years, when governments accumulate unprecedented debt levels, when stock markets reach valuations disconnected from underlying economic reality, when everyone believes this time is different, these are the conditions that guarantee eventual collapse. The financial elite understand this cycle and position themselves accordingly. They don't fear crashes. They prepare for them. Because crashes are when the greatest wealth transfers happen. When assets go on sale at 50-70% discounts. When fortunes are made by those with cash and courage. While the masses lose everything through panic selling and emotional decision-making. And 2026 is shaping up perfectly for the next crisis. Stock market valuations are at historic highs despite economic fundamentals that don't support them. Corporate debt is at record levels. Government debt continues exploding. The cost of living keeps rising while real wages stagnate. Central banks are trapped. They can't raise interest rates enough to combat inflation without triggering the crash. But keeping rates low continues inflating bubbles that will eventually pop anyway. The debt crisis is inevitable, and smart money is already positioning. Stick with me, and I'll expose exactly why 2026 looks like the breaking point. What historical patterns tell us about how these crashes unfold, and most importantly, the specific strategy for not just surviving, but profiting from the coming collapse while everyone else loses their wealth. Ready to see crisis as opportunity rather than catastrophe? Let's examine how to get rich when markets crash. Let's start with the pattern that makes crashes predictable. Every major financial crisis of the past century has followed a similar cycle of roughly 18-20 years between major collapses. This isn't mysticism or coincidence, it's the natural consequence of how the debt system operates and how human psychology responds to apparent prosperity. The pattern works like this. After a major crash, regulations tighten, risk aversion dominates, and slow recovery begins. But as time passes and prosperity returns, a new generation of investors who didn't experience the last crash enters the market. Regulations slowly erode through lobbying and financial innovation. Debt accumulates as cheap credit fuels speculation. Asset prices rise beyond reasonable valuations. Everyone starts believing that it's different this time, and that old rules no longer apply. Then some trigger event exposes the fragility, panic spreads, and the system collapses under debt it can't service. Look at the history. 1987 stock market crash. Then the dot-com bubble burst in 2000, 13 years later. Then the housing crisis and Great Recession in 2008. 8 years later shorter because the problems from 2000 weren't fully resolved. Now we're in 2025, 17 years since the last major crisis, and every warning sign is flashing red. Stock market valuations measured by metrics like price-to-earnings ratios and market cap to GDP are at or exceeding levels seen before previous crashes. The S&P 500 trades at multiples that only make sense if you assume eternal growth and zero interest rates forever, assumptions that history proves are always wrong. Corporate America is drowning in debt taken on during years of artificially low interest rates. And many companies can barely service that debt even with rates still relatively low by historical standards. And government debt is the elephant nobody wants to acknowledge. The U.S. national debt exceeds $38 trillion and grows by over $1 trillion per year. This debt must be rolled over constantly, meaning new bonds must be issued to pay off maturing bonds. And if investors lose confidence or demand higher interest rates, the debt spiral becomes uncontrollable. Other major economies face similar or worse situations. Japan's debt exceeds 250% of GDP. European nations struggle with both national and EU-level debt, and developing nations face debt crises that could trigger contagion. The system is overextended, over-leveraged, and operating on faith rather than fundamentals. The question isn't if the next crash will come, but when. And 2026 sits perfectly in the historical pattern while also aligning with multiple converging risk factors: political instability, geopolitical tensions, climate-related economic disruptions, and the exhaustion of monetary policy tools that central banks used to fight previous crises. The financial elite who study these patterns are already moving to cash and preparing to buy when the crash comes. The masses are still buying at peak prices, convinced this time really is different. Now let's expose the uncomfortable truth that crashes don't destroy wealth, they concentrate it. Every major market collapse in history has been followed by a massive wealth transfer from the many to the few. From retail investors who panic sell to institutional investors and wealthy individuals who buy the fear. During the 2008 crisis, millions of ordinary people lost their homes, their savings, and their retirement accounts. Meanwhile, the financial elite who had positioned in cash bought real estate at 50% discounts, purchased blue-chip stocks at crisis prices, and accumulated assets that would multiply in value during the recovery. Warren Buffett's famous quote captures it perfectly. Be fearful when others are greedy, and greedy when others are fearful. The rich get richer during crashes because they have the capital to buy when everything is on sale, and the discipline to hold through the panic. The mechanism is brutally simple. As markets crash, fear drives selling. Retail investors who bought stocks at peak prices watch their portfolios decline 30%, 40%, 50%, and panic. They sell to stop the bleeding, locking in losses. Mutual funds and ETFs face redemptions, forcing them to sell holdings regardless of value to meet withdrawal demands. Margin calls force leveraged investors to liquidate positions. The selling pressure drives prices even lower, creating a feedback loop of fear and forced sales. But for those holding cash, this is the opportunity of a lifetime. Quality companies with strong fundamentals that were overpriced at market peaks become available at 50-70% discounts. Real estate that was unaffordable drops to reasonable valuations. Bonds from solid issuers yield attractive returns. The assets don't change, Apple is still Apple. Good real estate is still good real estate, but the prices crash because emotions override fundamentals. And here's the critical insight. The recovery is predictable. Central banks will respond to crisis by slashing interest rates to zero, implementing quantitative easing, providing liquidity to markets. Governments will pass stimulus packages, infrastructure spending, maybe even direct payments to citizens. These responses inflate asset prices, rewarding those who bought during the panic while doing little for those who sold out. Within 3 to 5 years of major crashes, markets typically recover to previous highs, and then exceed them as the money printing drives everything up. Those who bought quality assets at crash prices and held through the recovery see 100%, 200%, even 300% plus returns. Those who panic sold and sat in cash miss the entire recovery and re-enter markets only after prices are high again, setting themselves up to lose in the next crash. This pattern repeats every cycle because human psychology doesn't change. Fear dominates during crashes, greed dominates during booms, and the financial elite who control their emotions profit from those who don't. The wealth gap expands, not despite crashes, but because of them, as those with capital and discipline buy from those with fear and desperation. The next crash will be no different. Let's examine the specific strategy for exploiting the coming crash, because understanding the theory means nothing if you don't know how to position. The strategy has 3 phases: preparation, execution, and patience. Right now, in 2025, we're in the preparation phase. This means building cash reserves despite the temptation to stay fully invested while markets still rise. Yes, you might miss some gains if markets continue up through 2025, early 2026, but that's the insurance premium you pay for being ready when the crash comes. The financial elite don't try to time exact market tops. They gradually shift to defensive positions as valuations become extreme and warning signs accumulate. This means selling portions of holdings when everything feels great, resisting FOMO, fear of missing out, and building a war chest. How much cash to hold depends on your situation, but aim for at least 30-50% of investable assets in cash or cash equivalents by late 2025. This doesn't mean stuffing money under a mattress. Money market funds, short-term treasury bills, or high-yield savings accounts preserve purchasing power while keeping liquidity. Don't try to be a hero by being 100% cash too early. You'll underperform if markets continue rising. But don't be the person fully invested when the crash comes. The second phase is execution during the crash itself. When panic peaks, when headlines scream about financial apocalypse, when your neighbors are selling everything, that's when you buy. Not all at once, but systematically. As markets fall 20%, deploy 25% of your cash. At 30% down, deploy another 25%. At 40-50% down, deploy the remainder. Focus on quality. Companies with strong balance sheets, real revenue, dominant market positions, real estate in solid locations with genuine demand, government bonds from stable nations. Avoid speculative junk, meme stocks, or anything relying on continued bubble conditions. The third phase is the hardest: patience. After you buy during the crash, markets will likely continue dropping. You'll feel stupid for not waiting longer. Fear will tempt you to sell. Friends will mock you for catching a falling knife. But this is where fortunes are made, by holding quality assets bought at crisis prices through the recovery. History shows that within 3 to 5 years of major crashes, those who bought the fear and held are massively ahead. The key is avoiding leverage that could force you to sell at the worst time. Don't buy on margin. Don't overextend on real estate. Buy with cash you can hold for years. The wealth transfer happens not just through buying low, but through holding until the recovery drives prices above where they were before the crash. The masses who panic sold at the bottom and missed the recovery lose twice, once on the way down, once on the way up. Those who bought the panic and held through discomfort win both ways. The 2026 crash, if it comes as the patterns suggest, will be the wealth-building opportunity of a generation, but only for those who prepare, position, and have the discipline to execute when fear is highest. The financial elite are already preparing. The question is whether you'll join them or be part of the wealth transfer going the wrong direction. So there's the complete picture. Crashes are predictable through historical patterns, with 2026 sitting perfectly in the 18-20-year cycle, while showing all the warning signs of extreme debt, speculation, and overvaluation. Wealth doesn't disappear in crashes. It transfers from the unprepared to the prepared, from the emotional to the disciplined. And the strategy isn't complex. Build cash now through 2025, early 2026. Buy quality assets when panic peaks. Hold through the recovery. Those who execute this strategy during the next crash could see life-changing wealth creation, while those who panic or stay fully invested through the collapse could see devastating losses. The question you face is uncomfortable but essential. Will you be part of the wealth transfer going up or down? Will you have cash ready when assets go on sale, or will you be forced to sell at the bottom? Will you buy fear when everyone else is selling, or sell fear after everyone else already has? The difference between these choices could be millions of dollars over your lifetime, because crashes are when fortunes are made or destroyed, and the next one is likely closer than most people realize. Here's what I need you to do. Honestly assess your current position. Are you overexposed to stocks at all-time highs? Do you have cash reserves ready to deploy during a crash? Have you identified quality assets you'd want to buy at 50% discounts? If not, start preparing now. Don't wait until headlines announce the crash. By then it's too late to position. Begin gradually moving toward defensive positions through 2025. Build your cash war chest. Study what assets you want to buy when prices crater. Most importantly, control the emotions that will tempt you to panic sell or miss the buying opportunity. And if this video opened your eyes to seeing the 2026 crash as opportunity rather than catastrophe, subscribe to this channel right now, because as the crash approaches, I'll be analyzing indicators, timing signals, and specific opportunities to help you execute this strategy successfully. The masses will lose wealth in the next crash. The prepared will gain it. The choice is yours.